Folks, today I'm going to talk about hedging strategies that you can apply to your own account. Now, I want to talk about a couple of different ways to hedge your portfolio and to show you a way that I recommend you do it. Now, this is not a holy grail. It's not a complete science. You're never ever going to have the perfect hedge. It's impossible to have a perfect hedge. But one of the things that I like to look at in my hedge is the ability for the asset to move higher, but at the same time, to not lock in the loss on my position. So let me explain what I mean. So for example, we're looking at the S&P 500 right now. And as you can see here, the S&P 500, or as you will be able to see in a few seconds, the S&P 500 is at all-time highs. And if you look at momentum levels, you will see here that the market is overbought. Not only is it overbought, it's diverging. Let me show you what that means. You've got an asset that's making lower highs. Right here, see, look at that. The oscillator is showing lower highs, but momentum levels are moving lower, but the S&P is still rising. So that's called divergence. This is a divergence because you have lower highs on the RSI and you have higher highs on the price action. And eventually what that's telling us is that momentum levels can't keep up with the upside on price and something has to give. And usually what gives is the S&P 500. Now, I'm not expecting a major correction. I'm expecting a minor correction. Maybe the S&P goes to the 50-day line or to the twilight zone area, which is between the 50-day moving average and the 200-day moving average. That's the ugly mustard colored line right here, unless you like ugly brown colored lines. But to me, that's an ugly mustard colored. Regardless, the point is, I think we're going to have a sell-off. Now, this sell-off is going to be short, and it doesn't make a lot of sense for traders to unload or put stop losses in their positions because I'll explain to you something. Stop losses tend to get picked off. One of the biggest reasons why, if you look at statistics and if you look at trading breakouts, you will see that some breakout trades have about a 35–40% profit ratio, profitability, whereas pullbacks have sometimes 70–80% profitability. The reason why breakouts don't have high profit per trade, not profit factor, they actually have a high profit factor per trade. They don't have high probability of winning per trade. They're only accurate about 3 out of 10 or 4 out of 10 times instead of 7 out of 10 times, is because volatility is so great. When volatility is so great, you have potential for a lot of profit, which is why the profit factor or profit potential is high. But at the same time, you have potential for downside, volatility. So how can you have your cake and eat it too? How can you have that magnificent, huge profit factor and keep your profitability 7 or 8 times out of 10. Let me show you. You can hedge your portfolio. And what a hedge does is it gives you a way to protect your portfolio against downside in the stock market without locking in that loss on a permanent basis. So let me show you 3 assets that are used very, very commonly for hedging. And again, these assets all tend to move up when stocks move down. So the first one is very simple. It's just a short, ultra short S&P, ticker symbol SDS. And this has a negative correlation with the stock market. Notice price has been going down. If you look at the SPY, you will see that price has been, during that same period of time, price has been moving up. So this is an inverse asset. It trades negatively to the S&P 500. And let's say you have a position in Dow stocks. And these blue chip stocks, Dow Jones stocks that your aunt gave you or your grandmother gave you 50 years ago. And say that she gave you these stocks to hold and they've been moving up and you've collected quite a profit in them, and liquidating them would be bad because you'd have a huge capital gain expense. So what do? You hedge the position. Or let's say you have a big portfolio and it's your retirement account and you believe the market's gonna go down, but you don't wanna liquidate and you don't wanna take a big down dip in your assets. You wanna have that liquidity, that volatility and liquidity offer you the same risk to reward. You don't wanna have a lot of peaks and valleys in your retirement account, for example. This is a good asset. You can initiate it right when you think the market's going down for every share. And it has leverage, double leverage, triple leverage. I think it even has quant leverage. But the point is, you can buy a short position and you can reduce your account exposure by the amount of the short that you have it. And this is 1 for 1. For every dollar the S&P falls, this will give you a dollar rise. And again, this is not the best way to hedge because it'll lock in that loss. Maybe not for tax purposes, but it'll lock that exposure. So another hedge that hedge funds and large investors use is gold. Gold is a great asset. Gold tends to be a great hedge for the S&P 500 because gold tends to rise when stocks go down. Because think about it, stocks go down, what do people do? They put their money in diversified assets, and gold is a diversified asset. It has really good negative correlation from the S&P 500. And as you could see here, when the market was really selling off during that nasty COVID period, let me show you this. Selling off from February, it came back. And it came back pretty well. So again, a lot of traders will use gold to hedge their S&P exposure. And another thing is gold miners. Gold is trading right below the 200-day moving average. A lot of the gold miner stocks are still strong, and gold is going through a multi-year rally. So I wouldn't write gold off. And one of the benefits of using gold instead of the SDS for a hedge or the short S&P as a hedge is your correlation is not 100% exact. That could be a negative, but can also be a positive because you can hedge yourself and you can see gold actually go up with the stock market. So your hedge can actually be giving you a positive delta and not just protecting you. So that's gold. And again, gold is a great hedge. About 30% of professional traders usually have gold in their account. And if you don't have gold in your account, take 5–10% of your account and put gold into it. It will create less volatility and less exposure in your position. And now, finally, let's talk about my favorite hedge. This is TMF. This is a triple leveraged 20-year bond ETF. And bonds typically move inverse to the stock market. You might have heard the term flight to quality. When investors typically take assets from momentum hedge funds, from large portfolios, when S&Ps are in vulnerable positions like they're at right now, when you have divergence between RSI and the asset, and you will see them put their money into gold. Again, gold is a great asset, into the bond market. And bond can also move up with the market. It doesn't have a 100% inverse relationship. It has about a 75% inverse relationship. But what I really like about the bond market is, if you look at the S&P 500, let me show you something interesting. If you look at the S&P 500 or the NASDAQ 100, you will see that typically the only time you have that direct negative correlation between the S&P and the bond market is when the S&P is reaching for the 200-day moving average. Otherwise, bonds kind of do their own thing. So for example, let's look at the bond market. Let's look at a chart. You'll see what I'm talking about. This is a good example. And I get a lot of traders saying, hey, how come, stocks are down 100 points on the Dow? How come the bond is not going negative? It doesn't work that way, which is why I like to only use bonds when the markets are really tanking. So if you look here, this is a period between June and September, okay, or August, June and August. Bonds went up, but if you look at the S&P, see how the market's going down here. The market is underwater here. Around the June period, the market is hitting the 200-day moving average. It's soft. It doesn't know what to do around this period. Right around here, market is getting fearful. See, before it started picking up. And if you look here, you will see the bond market rallying. So again, when stock markets go through periods of uncertainty, and let me show you weekly data. It may be easier to see it on a weekly data. Like this period right here happened in March of this year. Look at that rally in the bond market. And if we look at a weekly period, that's the stock market in March, right? I think this is what I was trying to show you. This is the stock market in March. And this is the bond market in March. So again, the bond market doesn't react, it's not very sensitive. It only starts really, really rallying when the S&P gets into deep, deep trouble. But again, that's when it's a good time to put on a hedge. So to summarize, a hedge can help you maintain a breakout or a high momentum, high volatility system, which is really good for big profits in the NASDAQ or in the S&P, but you need a hedge. If you use a stop loss, there's a good chance your momentum breakouts are only going to be about 30% accurate. If you use a bond as a hedge to hedge your bet and diversify your portfolio a little bit, your momentum trades could be accurate as much as 70 to 80% of the time, which puts them on the same league as pullback trades, which have a lot lower risk to reward ratio. So there is a way to make breakout trades give you a same type of exposure as pullback trades if you use a hedge. Also, to avoid tax consequences, to protect the portfolio, to get some upside from the market when the S&P is trading below the 200-day moving average or is actually going bearish, the bond market is a really good hedge. Now, there's a non-hedged, there's a non-leveraged version. It's ticker symbol TLT. But if you want the leveraged version, which is what I use, and you can buy options in this as well, ticker symbol is TMF. And this is, in my opinion, is the best hedge. When we saw the downside in the S&P in March, our hedge gave us over 600% gain in that. And we ended up March, if I recall correctly, really up instead of really down. So TMF is the ticker symbol. It's a bond hedge, and it really starts making a big difference when the S&P is reaching for the 200-day moving average. Right now, we're seeing momentum divergence. We're seeing overbought levels on the SPY temporarily, and it may be a good idea to start thinking about a hedge for your portfolio. It can give you an unfair advantage, and it can really turn your account from a losing trade into a winning position. I hope that helps. Folks, pay attention. I've got something big for you. At the height of the pandemic-induced stock market hysteria in March, I gave away my #1 trade at the time for free, no cost. And within just 1 month, the company shot up 92.5%. Pretty good, right? Now, the markets are moving all over the place. And I've noticed the exact same pattern that I saw in March lining up again, which is why I'm again giving away my #1 stock in the world right now. It trades on the NASDAQ and could earn you an easy $7,386 in 10 days or less. I can only let so many people in on my discovery, so make sure you click on the link below now. Don't procrastinate. Don't wait. Do it now.